Drawdown in trading and investing refers to the distance from a market's peak to a market's trough. So in this instance, I've just drawn out on screen, when price fell from this point down to this point, it fell by about 27%. And from this point to this point, that would be referred to as 27% drawdown. So this is what we saw on the S&P 500 from January 2022 up until October 2022. At that point, you were in 27% drawdown. In terms of max drawdown, that's defined as the biggest ever retracement in price witnessed in the market. Max drawdown is the way that we accurately define risk in trading and investing. While of course you need to invest with the mindset of don't invest what you can't afford to lose, you need some form of level to say, okay, I appreciate that, I'm not going to invest what I can't afford to lose, but how do I define the risk for each individual investment? And the way to do that is by looking at the max drawdown. Okay, so what's the biggest amount that it's ever lost as a percentage retracement in the past? Now, this doesn't give you some magical level that price could never fall beneath ever again, but what it does is it gives you a smart thing to look at to say, how volatile is this asset? What's the biggest amount that it's ever dropped in the past? And that will kind of give you an indication of, you know, how much it could drop in the future, or at least just know the biggest that it's done in the past, so that you can bear that in mind when you're investing. This isn't some magical level that price could never fall beneath again. Just because an asset has a 30% max drawdown doesn't mean that drawdown couldn't ever reach 40% again in the future. Rather, it's just smart to know the biggest drop that an asset has had before and has actually realized in the past, so that you have some form of indication of volatility, what has happened before in the past and how volatile it has been in the past. But that doesn't mean that you couldn't ever see a deeper drawdown level again in future, and it doesn't mean that it's just some magical level that price is going to stop at and then return because that's the most that it's ever done in the past. Of course, you can't ever rule out a 100% drop, and you should always invest with the mindset that you should never invest what you can't afford to lose for many reasons, even just the psychological element of you cannot lose that money. So seeing it do negative months or seeing it do losing days is going to absolutely wreck your head psychologically, because you're going to start to think if you lost that money. And knowing that you can't lose that money is just a very toxic headspace to be in when you're investing. Of course, you can't rule out a 100% drop, even on things like the S&P 500 or gold. However, if the S&P 500 or gold did drop to zero, I tell you what, me and every other smart investor on the planet would literally be loading up our orders and buying as much as it as we could. Now, speaking of this, I wasn't gonna do this, but this has just made me think of a really good example. During a world event that happened in 2019 to 2020, which I'm not gonna say the name of, but we saw this on the price of oil. Now, a lot of these oil charts won't actually show it, but let me see if I can find one that does. Okay, so here, this was the price of oil, and they commonly hide the previous prices so that you can't really learn too much about it, but here's a chart that it does show you it. So oil during the event in 2019 and 2020 actually went to pretty much zero. Okay, so if you invested in oil in 2018, by 2020 your investment is down like 95%. Okay, take the lessons that we've said in the previous videos and think about if you bought oil here. Okay, in 2020 you could pretty much buy oil for nothing. Okay, so imagine you're one of these banks that had an order lying like there at like $5, for example. You bought oil at $5 a barrel, just like that. You had a buy limit waiting on oil at $5 a barrel, and then you saw price run up all the way up here to like $130 a barrel. Okay, if you bought here in this trough and held it all the way up here, you would be up 2,500% on a spot purchase on oil. Okay, so price falling, losing days, losing weeks, losing months, losing streaks aren't all too bad, because they provide you with a much better entry point to get into the market with. However, this lesson we're talking about max drawdown. So for oil, for example, this has to be the max drawdown on oil. Surely, you can't get worse than this. it's pretty much almost 100%, okay, minus 95%. So that's what happened in oil during the event, which happened in 2019 and 2020, which I can't say due to the algorithm. What I'm going to do in this video is go through some case studies of the S&P 500 and gold, showing you some pretty big drawdowns that they faced when they faced them, and then we'll have a look at what the max drawdown is on these assets as well. Again, this gives you a picture on the previous volatility that they've faced and really help you to understand what drawdown is, what's the max drawdowns that you can kind of expect in the financial markets, how long it took to recover them, and the smart way to play them. And throughout this analysis, I want you to really take what we went over last lesson about dollar cost averaging and apply it to these drawdown periods. Starting things off, we're going all the way back to the 1930s with the S&P 500. Now, just a note for this, it wasn't technically the S&P 500 at this point because there were actually only 90 companies, so it's more like the S&P 90. It wasn't quite the S&P 500 at this stage, but it still gets treated the same because that's where it came from, so we're going to have a look at that regardless. Now, if you know a little bit about history, this was the Great Depression in America, and it was from 1929 till 1932. So this was a 3-year drawdown period, okay? And during which, from this point up here, price fell all the way down there, and we dropped about 86%, okay? So if you just deposited a lump sum at this point, your investment would have gone all the way down there, minus 86% over the space of 3 years. So it had a max drawdown length of 3 years, which is going to be from the very top to the very bottom, which we call max drawdown length. If we zoom out and look a little bit in the future, price came from here and it took all this time to reach that previous peak. So if I draw a line there, you can see that this level didn't actually get met again up until 1954. So again, if you would have deposited once as a lump sum here, you would have literally only just broke even on that investment in 1954. That is what we're going to define as the total drawdown period. The time it took for the market to go from peak through the drawdown and back to the peak again, which is the total drawdown period. Now, a popular saying that they have with the financial markets is that it will take the elevator down and the stairs up. And that's because the drawdown phases often happen in bigger movements and with quicker succession compared to the recovery phases, okay? So this drawdown period from 1922 up until the bottom in 1932 only lasted 3 years, but the recovery time from 1932 up until 1954 took 22 years. And that's another term that we're going to refer to as the recovery time. So this period here till this period here, we're going to call the max drawdown length. Just like that. Now this period here to this period here, we're going to call the recovery time, just like that. And the two of them combined, we're going to call the total drawdown length, like that. So you could say that the total drawdown length is the max drawdown length plus the recovery time, and all of that together makes the total drawdown length, which is when at any one point you've just been holding drawdown up until it comes back. Now, let's apply what we learned last lesson about dollar cost averaging. If you would have just deposited a lump sum here and held it until here, you wouldn't have made any money. You would have just been holding losses throughout a 25-year period. But imagine if you dollar cost averaged every single month throughout this move. Let's say you would have got an average buying price of even just there, okay? That would have been your gain. Even though from the day that you've started up until this day here, price didn't actually gain anything. If you dollar cost averaged month on month and bought throughout the drawdown, you've managed to actually make a return from trading the market throughout the short-term fluctuations over the long run. Now, that was all the way back in 1930. It was a pretty extreme scenario throughout the Great Depression. So let's look at some more recent times to get a picture of some more recent volatility. If we go back to early 2000, which is when we had the dot-com crash or the dot-com bubble, this was basically where technology was on the rise. It was like the AI of the time, where people just thought this was an absolute miracle of an invention. The world's going to be so much better with it. What basically happened is all the tech stocks got massively overinflated, got massively overvalued, and once they actually became a little bit more balanced and the market got priced in a little bit more, there was this crash which happened from 2000 and bottomed out in about 2002. So again, this one had a 2-year drawdown period. This was fully recovered in 2007. So we had a 5-year recovery time, which overall gave us about a 7-year total drawdown period on the S&P 500 from 2000 to 2007. So if we just plot those out again, you can see this is the max drawdown length, which is the maximal point from the peak to the trough. Then we've got the recovery time, which is the trough back to a new peak, which matches the previous peak. And then the total drawdown period is the total amount of time that you spent going from this peak all the way down and then back up again to match the previous price. Now, what actually happened with the S&P 500 here is as soon as the dot-com bubble was recovered, you then had another crash, which was the global financial crisis. And price again fell to a trough and came back, which again took place over another 6-year period. So from the 2000 to the 2013 period, you had a pretty rough ride investing in what was renowned as the most reliable index in the world. This is something that I think about, okay? So I'm 25 right now. 2013, I was only 13 years old. And you kind of have, like, I always think about the generation above me when they were my age and this was their experience with the financial markets, okay? There's no wonder a lot of them don't have hope in trading or investing, because going through that as a wild ride in a 13-year period, like imagine if you were 20 years old here and you were 33 here, okay? In your adult lifetime, from being 20 to 33 years old, you just saw the S&P 500 dump, recover, dump, and recover. You're going to have a pretty messed up idea about the financial markets, okay? Versus people in my generation, okay, we kind of just saw the S&P 500 go up, down, up, down, up, down. And for us, it was pretty obvious that, okay, it goes down, you just buy it and it'll go back up again. But you kind of have to bear in mind this market cycle was pretty rough from 2000 all the way over to 2013. Nevertheless, let's stay on topic and we'll look at the dot-com crash. And what we saw here was price go from this point down to this point, which was about a 50% crash, which took place from 2000 to 2002, so about 2 years. And the recovery time from 2002 to 2007 was about 5 years. So we had about a 7-year total drawdown period, 2 years to the bottom and another 5 years to recover. Again, if we look at a dollar cost averaging approach, you would have been buying throughout this movement down and you would have been buying throughout this movement up. So even during that whole recovery period, even during that whole drawdown period, you would have managed to get in at an average price and still make money in the long term, even though from this point to this point, the net result of price is zero, because you've actually got in a balanced price. Okay, next up we're going to look at what we just touched upon, and it was the global financial crisis in 2007. The peak was there, the trough was there, and the recovery was about there. Let's just line that up a bit more accurately, about there. Okay, so the initial peak was October 2007, and from here price fell about 58%, let's say 58%, and it took place from 2007 to 2009. So we'll call it's about a 1.5 year drawdown period, or max drawdown length. It took place from 2007 in October to March 2009. So let's call that about 1.5 years for the max drawdown length. And then it took price from March 2009 till April 2013 to recover that, just like that. And we'll say that's about a 4-year recovery period. In total, from 2007 to 2013, you had about a 6-year drawdown period, where if you would have just bought here and held it all the way till here, you would have made nothing. But if you dollar cost averaged throughout this move down, and then throughout this move up, you would have caught an average price maybe like there, and you would have actually made money from just regularly entering the financial markets during a dip, which then recovered. And even though the net result in price was zero, you still made a financial gain from the financial markets. So by using this dollar cost averaging approach, you can see that how even if the markets aren't moving up long term and they're in a drawdown phase where the net result is zero, if you just dollar cost average and spread your risk out over time, like smart investors do, it's a much better way to approach the financial markets. Last but not least, on the S&P 500, I've got an example here which is probably going to hit a lot closer to home for most people than the other examples. This was a world event that happened in 2019 and 2020. Again, I'm not going to say the name of it because I want to publish this on YouTube and social media, but you can see what happened here, and we all know what happened here in 2020. Price from the S&P 500 had a drop of about 35%, which is quite a tame crash compared to the ones that we've seen before, 57, 50%, 80, 90% crashes. Price in 2020 only crashed 35%, and it did so over the space of a few months. If we look on the monthly time frame, you can see that this crash only actually lasted a couple of months from February and March, and the recovery time was only about 6 months. 1, 2, 3, 4, 5 months. So that gives us a total drawdown period of only about 7 months. We took 2 months to crash and 5 months to recover. And look, I'm sure you get the gist of it by now, but you can imagine if you would have bought here and just held, compared to if you regularly bought throughout this drop and held throughout the recovery, you could have made a very nice return from your investments during that period compared to if you would have just deposited once and said, I'm going to see if this works. Okay, so imagine if you put £1,000 in there, saw the drop, was like, okay, this doesn't work, I'm going to pull my money out, compared to if you actually invested regularly and caught the average price of it as it moved, you'd probably be saying, wow, this really works, let me keep doing this. So those were some of the max drawdowns and drawdown periods that we've seen on the S&P 500. The biggest one was about 86% during the Great Depression in 1930. But again, that wasn't really the S&P 500. There were only 90 stocks in it at the time. More recent drops that were actually the S&P 500 were the dot-com crash, which was about 50%, and the global financial crash, which was about 57%. So even with the most reliable index in the world, the S&P 500, your max drawdown is about 57.5% if you're just going to buy and hold. Okay, so we've covered the S&P 500 pretty well. Now let's look at some examples on gold. So the ultimate buy and hold max drawdown on gold was in about 1980. So here you can see from this point up here down to this point in 1999 was the max drawdown that we've ever witnessed on gold. From this point down to this point, the market fell 70%. So if you would have put 100k in gold in 1980 and held it all the way till 1999, you'd only have 30k left. You'd be 70k down on your investment. If we take a look at the max drawdown length from this line to this line, we're looking at about 19 years. And then from this point, which is the ultimate low, back to the previous high, this was January 2008. So we're looking at about a 7.5 year recovery time. In total, from January 1980 to January 2008, you would have had a 28-year drawdown period. And from just buying and holding gold, we've seen a max drawdown of 70%. Next up, we've got the global financial crisis, which happened in 2007 and 2008. This was the ultimate high, and it fell to its absolute low there for about 35%. Now, from here to here, which is the actual drawdown length, this only happened from March 2008 to October 2008, so about 7 months. And then the recovery time on that to get back to its previous highs happened about there in October 2009. So this recovery time took about another 1 year. So in total then, from this move in the global financial crisis, we saw max drawdown of about 35%, which happened in the space of 7 months. Price then took another year to recover, so the total drawdown period was about 1 year and 7 months, whereby if you would have just invested a lump sum at this point, and held it all the way, you would have made 0 returns, granting that you didn't actually close the position for like 1 year and 7 months. But if you would have bought regularly throughout this time, you would have actually made money, even though the net result from here to here was 0. Here we have another stint of drawdown on gold, which happened from 2011, hit a trough down in 2015, and then didn't fully recover up until July 2020. Here we saw a drawdown of about 45% if you were to buy and hold. This drawdown phase lasted for about 4 years, from 2011 to 2015, and like we said, it didn't recover up until 2022, so the recovery time was about 5 years. This is one of those perfect examples where price held drawdown and then recovered pretty symmetrically. I mean, this was 4 years and this was 5 years, but still you can see the nice curve. So even though the net result of price was 0, because you invested regularly every month using a dollar cost averaging approach, you actually managed to make money even though the net result was 0. And then last but not least, an example that we have to look at is the global event that shook the world in 2019 and 2020. So this one impacted gold a little bit differently because remember, gold is a safe haven asset. So when things like crashes impact the world economy, sometimes they can actually do quite well for gold, because when money is coming out of those assets and into safe haven assets, that's healthy for gold. But in times when there is an ultimate crash, like the points mentioned, people kind of just liquidate all of their assets, wait to see how things play out, and then they'll invest it instead. So you can see when the events actually happened, there was an initial drop, but that was recovered within a couple of weeks. Okay, so this was the actual time where the S&P 500 was affected, but with gold it was a little bit delayed. Okay, so when we got to about August 2020, that's when things really got interesting, and it wasn't so much of a drawdown period as it was just a huge consolidation period, like I'll mark out with this box here. So it wasn't so much of a crash, it was more just we didn't really know if gold was going to move up or down, and then it eventually did break out and move massively to the upside from there. But nevertheless, let's do the same case study from here, which was August 2020, down to the absolute bottom here in September 2022. We had a drawdown length of about 2 years. And then in order for that previous high to be recovered about there, it actually recovered here, but wicked and then hit a new low, and then wicked and retraced, and then came back here and actually closed above that high at around December 2023. So because of that, we'll call this the recovery time, which was about a year from the low to this high. And in total, you were in drawdown or just consolidating from 2020 till the end of 2023, so about 2.5 years, during which time, if you just bought here and never bought again, you would have made nothing for 2.5 years, whereby if you were dollar cost averaging, again, you might not have made that much, but you still definitely got a better entry point by spreading it out over time, maybe catching an average price of like there, and still managing to make some gain, while the market return was 0. If I didn't mention it already, the max drop from this high to this low was about 20%. So the lesson here is that even with a safe haven investment like gold, and even with the most reliable asset like the S&P 500, if you just pick one time to invest and say, I'm going to put this money into this asset and try it or give it a try, by picking one time, you're essentially playing Russian roulette with that is a good time. That is not the smart way to approach the financial markets. With the financial markets, it's not just a I'm going to pick this one day and give it a try approach. It's a I'm going to spread this risk out over time and see how I get on over time. If price moves against you and the equity curve drops, with a dollar cost averaging approach, that can be a good thing because you're loading up on better buying positions, and then once price recovers, you've got a much better entry point than if you were to just say, I'm going to start today and see how it goes. As long as price is rising steadily over time, spacing your deposits out on a fixed interval is a much better way to approach the financial market. Now, it doesn't just solve all the problems because you still have to have the discipline to keep investing every single month, even though price is falling against you. And we've seen in this video some pretty extreme examples where gold, for example, has just been in a drawdown phase for like 27 years. that doesn't make gold a bad investment. And for those people that dollar cost averaged into that move, just think about the returns that they are seeing now, okay? The people that loaded up on positions throughout this move and then held are definitely one of the 1 in 5 people that leave the markets with more money than they deposited. However, for all the people that panic sold and said, you know what, I deposited in 1980 and it's now 1983, gold doesn't work, I'm going to pull my money out, they're one of the 4 in 5 people that lost money, even though they are probably looking at their trade log and thinking, oh my god, I sold my gold at about $500 and it's now worth almost $4,000 at this point in time. And let's not even get into people that bought and sold Bitcoin between 2010 and 2020, because I know they're pulling their hair out right now. So look, this video isn't just about hindsight and looking what has happened. It's about learning from the past and learning about how you can play the financial markets going forward in the future. If safe havens like gold and reliable indices like the S&P 500 experience waves of price differences like this, you can't expect to trade and be alien from these laws as well. All trading strategies, no matter how good they are, how bad they are, will have winning streaks, losing streaks, and experience drawdown phases. The important thing is learning and understanding the laws of financial markets and approaching them with logic and structure instead of emotion and fear and just guessing. Even safe havens like gold and the S&P 500 go through drawdown phases. No matter how good a trading strategy is, the laws of the financial markets will apply, and you need to understand how to approach them with logic and not emotion. With dollar cost averaging, drawdown phases can actually be really good buying opportunities to load up on your position, instead of being scared and running away from the markets because you've had 2 losing months. When it comes to trading and investing, if you're not in control over your emotions, then the markets are in control of them. And if the markets are in control of your emotions, you're definitely one of the 4 in 5 people that lose money to them. Instead, play it smart and from an educated perspective.